So we'll be going over IRS Form 461, Limitation on Business Losses. So this is a relatively new tax form. It was created in the aftermath of the Tax Cuts and Jobs Act that was passed in 2017. So this basically places a limit on the amount of losses from either trades or businesses for non-corporate taxpayers that they can claim in the current tax year. So you can't take an excess business loss. That business loss is considered to be a net operating loss and subject to being treated as a net operating loss. So you can refer to IRS Publication 536, which deals directly with net operating losses for individuals, estates, and trusts to get more information on how to treat it as a net operating loss. In this tax form, we're simply going to calculate the total amount of that based on the rules that are set forth. So in part one, we're going to report all the different income and loss items from either trades or your business as they might have already appear on your tax return. Then in part two, we're going to back out certain amounts of either income or gain or losses or deduction that were not attributable to any trade or business. And then in part three, we're going to calculate the limitation on your losses. So if you don't have an operating loss, you're not going to show one here. You don't need to file this form. If you do have an operating loss, then we'll take a look at what you would do with it. So in part one, let's start with line one, which the IRS has set aside for future use. So in line two, we're going to enter the line three amount from your Schedule 1. So Schedule 1 reports additional income and adjustments to income. Now, line 3 from that happens to be the information that you would put in from your Schedule C. So if you don't have a Schedule C, then line 2 is going to be blank. However, you would carry this number from your Schedule C into line 3 of your Schedule 1. That's the number that we're going to put in here. So in this case, our hero, John Q. Doe, is reporting a $50,000 loss on his Schedule C. The next line comes from line 7 of your Form 1040. So this is the line 3 amount, and that happens to be the capital gains or losses that are being reported on your tax return. You may need to file Schedule D to calculate that. You may need to file IRS Form 8949 to calculate that. But at the end of all of that, the number that you put into line 3 will come from that line 7 from your 1040. Lines 4, 5, and 6 in here come from Schedule 1, line 4. So line 4 happens to be other gains and losses, and you would originally calculate that amount on IRS Form 4797. Line 5 comes from Schedule E, so this is supplemental income from rental real estate, royalties, partnerships, S corporations, trusts, states, etc. So supplemental income and loss. And then line 6 is farm income or loss that would be reported on Schedule F. So as I've gone through each of these lines, if you don't recognize the name of the form or the schedule, then you might not have that in your tax return. For example, most people know whether or not they're reporting farm income. So if it doesn't apply to you, just leave that blank. In line 8, you would enter any other income, gain, or losses from a trade or business that you did not report on lines 1 through 7. So it's important to note that the form instructions don't go any further into detail on what kind of income, gain, or losses you would report here, but you wouldn't have reported elsewhere in your tax return. So we put in a placeholder of $5,000 just to fill in that space, but uh, there's no specific examples of types of income that you would put in line 8. So in line 9, you're going to combine lines 1 through 8. So in this case, we started with a $50,000 loss. After all of the other income, it's now a $25,000 loss. So in part 2, we're going to make adjustments for any amounts that were not attributable to a trade or business. So you don't have to specify anything, but if there was a capital gain because you sold your house, that wouldn't be attributable to your trade or business. Or if it was personal investing and you're not in the business of that investing, then it's technically not attributable to your trade or business, and you would back that out. So income or gain, we put in $10,000. In line 11, we're going to enter any losses or deductions. And then we're going to net those two together. We're going to subtract line 11 from line 10. We come up with $5,000. So that's the adjustment we will make in part 3. So in part 3, it says, if line 12 is a negative number, enter it as a positive number here. If line 12 is positive, enter it here as a negative number. So that's what we did here. We entered it as negative $5,000. We're now going to add that to the negative $25,000, and we come up with negative $30,000. Now, John Doe is a single tax filer, so we put in the $270,000 limitation here in this worksheet. It is important to note that this number is adjusted annually for inflation. At the time of this recording, the 2022 version of this form was the most recent version that I had access to, so that's what we used. But the limitation has actually increased from 2022 to 2023, and it's increased even more for 2024. So for the 2023 tax season, you would see $289,000 here for single filers. You would see $578,000 for married couples filing jointly. And then for 2024, the amounts go to $305,000 and $610,000 respectively. So we're using this in the 2022 context. So we put the $270,000 here, and then we we added those two together. So basically we got $240,000. If it's less than 0, then you're going to go back to Schedule 1 and enter that as a positive number on line 8P. So line 8P literally is reporting, quote, Section 461L excess business loss adjustment. So you would enter that here. That is a positive adjustment. So that basically means that it increases your additional income, so to speak. If this number is greater than 0, then you would not attach it to your tax return. So let's imagine that we took negative $300,000. And that gives us negative 275. We bring that down here, and now we're at negative 280. We would enter the 270, we would add those two together, and now we have a negative $10,000. So we would take that negative $10,000, put it on Schedule 1, line 8P as a positive $10,000. So there are a couple of bits of guidance on here. There are what's known as ordering rules. So when calculating business losses, you have to do so in order. First, you would have to determine whether or not there are any at-risk limitations. So let's imagine that you started a business and you took out a loan for half of the startup, but that loan was guaranteed against loss. You didn't have to pay it back. Your investment was never really in danger. You were always going to at least get your money back. Well, then you would have to complete IRS Form 6198 to determine your limitations based on the amount of capital that you put at risk versus the amount that you did not. After that, you would apply passive activity loss limitations, and in general, your passive activity losses are limited to gains from other passive activities. And then on top of that, you would apply the excess business loss limitation. So all of these are different limitations that prevent people from taking excess deductions in one tax year. You would be able to carry them forward generally. There may be situations where you can carry certain losses backwards. Those are outside the scope of this discussion. This simply helps you calculate that loss limitation and apply it to your tax return. So that's all we have for this tax video. If you like this video, you can, and you want more information, we go into much more detail in the article, which you can find the link to in the show notes, or you can simply go to teachmepersonalfinance.com, type in IRS Form 461, and you'll see our article appear. If you like our articles, please subscribe to our newsletter, and if you like our videos, please subscribe to our YouTube channel. And if you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.